since we last met for the quarter. And at that point of time, in the H2 report, I remember mentioning that we had clocked in our best ever performance in the commercial office sector, when annual leasing recorded a historic high of 71.9 million square feet, which was for the first time that we had crossed the 70 million number. The residential sector at that time also had significant momentum, with annual sales in 2024 touching a 12-year high. Since then, over the last 6 months, much has transpired on the geopolitical front. The conflicts remain ongoing in both Eastern Europe and West Asia, and the uncertainties surrounding the tariff regimes in the United States continue, causing volatility which has impacted global economies. Despite these challenges, the Indian economy has demonstrated resilient growth in 2025, driven mainly by robust domestic consumption and public investment, even though industrial growth moderated during Q2. While some of the forecasts vary, most suggest that India will remain the fastest growing economy in the major economies, with projected GDP growth ranging from 6.2 to 6.7% for the fiscal year 25-26. And this underlying strength has again reflected in the performance of the two key elements or segments of real estate, that is residential and commercial. While the commercial residential market has maintained its momentum in both sales and supply compared to the same period last year, the office market experienced yet another blockbuster run in the first half of this year. In H1 2025, the Reserve Bank of India took a bold step by cutting the repo rates by a cumulative 100 basis points starting from February. This has led to a pass-through of approximately 85 basis points, providing a significant psychological boost to buyer sentiment. In fact, as mentioned in our release around 10 days ago, home affordability reached one of its best levels in a decade in June 2025, meaning home affordability reached a historic low when I say the best levels. The affordability index fell to a historic low, with all major markets now well below the 50% threshold. Notably, Mumbai dropped below 50% for the first time, recording an affordability level of 48%, while Ahmedabad was the most affordable city, falling well below 20%. While the team will take you through the detailed findings of H1, I want to reiterate that our objective in Knight Frank is to go well beyond the headline numbers and uncover the true essence of the market. Our constant endeavor has been to present a realistic and a nuanced picture. For example, there has been many commentators today who are speaking about the marginal rise in unsold inventory. But we feel that such topics like unsold inventory, etc., must be viewed in a proper context. So we view unsold inventory, and as Vivek will discuss that in great depth in his presentation, must be viewed in the context of sales velocity, quarters to sell, and the inventory age, which actually reflects market health, and unsold inventory is just one part of it. Therefore, the slight increase in inventory or in unsold inventory is not necessarily a cause of concern. In fact, it may serve as a balancing factor in the current market environment. As I just mentioned, we also go to great depth in our analysis rather than just the headline numbers. We analyze residential sales in price bands which are fairly granular. And this granular approach analyzes price bands below 50 lakhs to those above 50 crores per apartment or per dwelling. This granular approach has provided us far sharper insights into evolving demand patterns and the corresponding supply side responses. In H1 2025, all segments of homes priced above INR 1 crore have recorded growth. Interestingly, NCR and Bangalore posted higher sales of 1 crore plus homes than Mumbai, indicating a shift in residential buying patterns and affordability dynamics. However, the decline in demand for homes priced below 50 lakhs and those between 50 lakhs to 1 crore has continued in 2025. We have adopted a similarly detailed approach in evaluating the office segment, which has delivered yet another spectacular performance. Gross leasing demand has reached nearly 50 million square feet, exceeding the full year volumes of years like 2016 and 2017. India's emergence as the preferred destination for global capability centers, or GCCs as it is known, has been the key driver of this growth. In H1 2025, GCCs accounted for nearly 40% of total office leasing, equivalent to the shares of Flex and India-facing businesses put together, establishing GCCs as the leading demand driver in the sector. Flex spaces and managed offices, while maintaining a 21% share of overall demand, have also grown in absolute terms as global and Indian companies continue to favor flexibility. Notably, in this half year, the third-party IT services sectors has also recorded significant year-on-year increases, adding further momentum to the office sector. Bangalore, of course, is the clear forerunner, with over 18 million square feet of office demand recorded in this segment, in this half year. Office demand is growing at an incredible pace in Bangalore, owing to its long legacy, competitive office spaces, and talent pool. This growth is expected to remain unabated, as the city has also recorded one of the highest pre-commitments for the first half of the year. All indicators point to a strong year to the office segment in 2025, although numbers in the second half may or may not match that of H1. Typically, H2 demand outpaces demand in H1, but in this instance, a substantial share of H1 demand came from pre-commitment of office spaces. A growing concern is that the low level of office supply, which continues to lag well behind demand. Nonetheless, we remain optimistic and confident of another robust year for the office sector, potentially achieving record-breaking performance for the third consecutive year. With that, I'll now hand over to the panel that will take you in detail through these findings. Today's presentation will walk you through the key trends shaping both the office and residential markets. To present the high insights from this report, I am delighted to introduce our distinguished Knight Frank panel of experts. Mr. Gulam Zia, a Senior Executive Director, Research Advisory, Infrastructure and Valuation. Mr. Viral Desai, a Senior Executive Director, Occupier Strategy and Solutions, Industrial and Logistics, Capital Markets and Retail. And Mr. Vivek Rathi, who will present the report on National Director, Research. Before I hand over to Vivek, I'd like to acknowledge and congratulate the authors of this insightful report, Mr. Yashwant Bangera, Mr. Naresh Sharma, Ms. Urvashi Jagaset, Rishabh Soni, Manjuma Sen, and Mohit Joshi. Before we begin, a few quick housekeeping notes for those joining us via webinar. All attendees will be in listen-only mode during the presentation. We will answer the questions at the end of the session. Mr. Gulam Zia will moderate the Q&A session. Please feel free to share your queries via the chat function or by raising a hand. And if by any chance we are unable to answer your questions due to time constraints, as usual, please be rest assured that our experts will follow up with you immediately after the event. I look forward to an engaging and thought-provoking session as we explore the insights and opportunities shaping India's real estate landscape. And with this, I hand over to Vivek. Thank you.
Thank you, Shishir. I hope I'm audible. Right, thank you. So, Shishir very well captured the theme and essence of the office and residential market in H1 2025. What I'll try to do is get into the details of what is happening in all of these. We'll begin with the office segment. Now, if you look at the office segment, so while we're talking about the H1 2025 period, let's have a recap of 2025 period until 2025. Now, in this slide, what you see is transactions continued on a steady uptrend since the pandemic and culminated in an annual record transactions in 2024, up 21%. Similarly, supply was also on an uptrend, even while it lagged demand. So it fell short of demand, but was higher in 2024. Now, in 2025 H1, the office demand has skyrocketed and it is 41% higher, 48.9 million square feet across the top 8 cities. Supply is staggering, and now what that means is the supply side of the market has remained depressed, with only 20 million square feet getting completed in H1 2025, much lower than the demand seen during this period. Development remains heavily skewed towards the residential space due to the strong demand and higher returns afforded there. The scenario is gradually changing, and in the subsequent periods, we may see demand, office space supply coming in. But currently, a very strong level of office transactions, but supply which is not able to match the pace. As a result, with this stark mismatch in demand-supply environment, vacancy levels have continued to trend down in the past 5 years. And now we are at a 5-year low of vacancy levels at 14.7%. So we were at 17.2% just during the COVID period. And now it has, because of the demand-supply balance that I spoke about, it has continued to trend down and at a 5-year low. Let us now look at the underlying drivers of the massive volume seen during H1 2025. GCCs led the market by a huge margin among the 4 end-use categories we track and accounted for 19 million square feet, almost double of what this segment has taken up in H1 2024. Flex spaces have consistently made their presence felt in the market. It grew by 43% to 10.2 million square feet in this period. What we find particularly encouraging is the fact that the performance of third-party IT services has improved. It has almost tripled compared to the previous period. So what do these segments mean? If I were to give you some examples of GCCs are companies which have set up their global centers in India to deliver work across the globe. The likes of JP Morgan, in BFSI, Novartis in healthcare, and so on. When it comes to third-party IT services, it represents companies like TCS, Wipro, and so on. India-facing businesses are businesses which are catering to the domestic demand, your Reliance and Adani's and so on. When it comes to flex space, the popularly known as co-working companies, the likes of WeWork, Office, and so on, are considered in this group. So GCCs have continued to uptrend. Here, what we can see is the increasing impact of the GCCs on the market volumes over the last 3 years. From a 25% demand share in H1 2022 across these 8 cities, it has scaled up to 39% in the current period. India's high quality talent pool, friendly business policies, and a massive consumer base have allowed these companies to increase their tally. If you look at the markets which contributed, Bangalore has dominated 18.2 million square feet, a tally which is close to the full year tally of the previous year. At the same time, markets like NCR, Pune, and Kolkata, these have also recorded their all-time highs when it comes to the H2 2025 performance. So it's an all-round performance. Some markets, particularly because of their base effect, have marginally trended down, whether it is Mumbai or Ahmedabad. But otherwise, it has been an all-round performance with all markets contributing. Now, while we spoke about the numbers for Bangalore, which are stellar at 18.2 million square feet, particularly what led to this is the pre-commitments which happened in this market. 61% of the pre-commitments were taken up by the GCCs, and most of these were concentrated in the markets of PVD East, which are Whitefield and Marthali. Now, what do we mean by this? I spoke about the supply falling short of the strong demand. As a result, the occupiers had to wait to sign up for spaces, and these pre-commitments will ensure over the next 1 to 2 years they get the spaces that they wish to set up their centers at. Vacancy levels have continued to trend down. National level, we saw it is at a 5-year low. Now, across these markets, 8 markets, 6 out of these 8 have seen vacancy levels to come down, with an exception of only NCR and Pune, where it has gone up, particularly because a lot of new supply additions happened in this particular period. Not surprisingly, with all of this in the backdrop, rent growth has continued to remain strong. Mumbai and Hyderabad grew the most at 12% and 10% respectively. This slide shows the prevailing rent and vacancy levels in the prime locations across the leading markets. So one level, we saw the headline level vacancy, and the country level, we saw city level, how it has trended. But then there are many of these prime markets which are favored by occupiers. And as you can see on the slide here, many of the occupier favored premium markets are witnessing a supply squeeze. Vacancy levels in most of these are in single digits, with some exceptions like say a market like Connaught Place, where there is a lot of old stock or non-contemporary stock. So as a result of all of this and the strong undercurrents which we are continuing to witness, what we expect is a blockbuster year in 2025. Now, in 2025, in the past trends of the last 13 years, what we've seen is 11 out of 13 years, the H2 has continued to maintain a growth over the previous period of H2 2020, previous year. And if this is to be continued, even on a conservative basis, as in the same way, it will exceed close to 85 million square feet. So in that sense, these numbers are quite conservative and likely to happen in 2025 close. So in a nutshell, for the residential market, demand has set a new record at 49 million square feet in H1. GCCs will have taken a lead, and third-party IT services have made a rebound. Supply morbidly below demand and could impact the demand in future. And Mumbai and Hyderabad rents recorded the maximum growth. We move on to the residential market. The residential market has been on a strong growth path since the pandemic, and sales volume in this slide, which highlights the last 13-14 years period, it was at a 12-year high in 2024. Sales and launches grew by a healthy 7% and 6% respectively during the 2024 period. Now the growth trajectory seemed to be tapering but healthy, and by that what I mean is between since the pandemic 2021 to 22 and 23, 24, we've seen the growth rate has been moderating. However, the levels continue to inch up. Now, what has happened in this period, H1 2025? The market has recorded stability this year. Levels have plateaued in H1 2025. So we're talking about a 2% moderation in sales across the top 8 cities. 170,000 units sold across the top 8 cities. Volume of units launched has also mirrored the movement. And in this, it is about 179,000 units. So a little ahead of demand, but continued to remain in the same trajectory. Market-wise performance was mixed. 4 of the 8 tracked cities saw sales growth, with Chennai, Hyderabad leading at 12% and 3%. Mumbai retained the top spot with 47,000 units, closely mirroring the last year's sales volume. And NCR and Kolkata saw volumes drop, particularly due to a significant base effect. As a result of these demand-supply dynamics, unsold inventory over this period, particularly in the last 3 years, has continued to trend up gradually. And it has up 44% in H1 2025. Now, on its own, unsold inventory is an indicator of some pressure building up. But is it really a pressure? It has to be seen in conjunction with other indicators, like Shishir mentioned. Particularly, we have calculated the quarters to sell, which is a 8-quarter average weighted indicator, to see how balanced it is in terms of the time it is going to take to sell even the enhanced level of inventory. Now, this remains very stable. This slide shows the number of quarters it will require to consume all of this inventory if no new launches happen. This metric has consistently been improving since the end of 2020, as you can see in the chart, and has remained very stable in the current period. So 5.9 last year and it's about 5.8 this year, which means close to 1.5 years to sell all of the inventory. It is much lower on an average for a completion or a project construction cycle. And that is what is comforting for the supply side. Now, on the pricing front, price growth has been healthy in H1 2025, despite a pause in overall sales, as developers have postponed project launches to control inventory pressure. So we've seen the growth rates moderating over the last 4 years, but still continuing to record stability. Now, instead of lowering prices for any categories, including the lower segments, what developers have done is continue to maintain price momentum and offer some financing incentives, as the case may be for the market. Most of these markets have continued to record growth, with NCR and Bangalore recording 14% growth each in this period, which is a very strong growth. And others have also, at the market level, continued to grow between 2 to 6, 7%. Now, this was the picture for the overall market. Now, let's look at the categories, particularly the higher value categories, which have continued to do very well. So on one hand, we saw stability on the overall volumes, numbers about 2% down. But when we get into the details, particularly in the segments of 10 million and above, which is 1 CR ticket size, it has recorded a 17% growth. And as you can see in the ascent of this chart, it has continued to go up in the last 7 years. So it's not a phenomena which has happened in an isolated manner in this period, but a trend which has continued even in this period in the backdrop of all of the challenges that came. 49% of the sales now happen in the 10 million plus category. And by that, what we mean is the significance of this category has continued to go up. Now this category is 121% higher than the affordable category, which is less than 5 million segment, right? So the lowest segment, and in comparison to it, this category is 121% higher. It is higher by 70% even in comparison to the medium mid-value category, which is the 5 to 10 million segment. As a result, the share of this segment has grown consistently from 15% in H1 2018 to 49% currently. and been the primary driver of all of the activity and the positivity we've seen in the housing market across the country. Development activity has also been in line with the changing preferences of home buyers, and the segment now constitutes 56% of the total volumes launched. So over 100,000 units were launched here, which was an 18% growth in YOY terms. So on one hand, we saw about 2% dip in the launches for the mainstream of the overall market. In contrast, here we have an 18% increased supply level. Now, at the same time, this has caused unsold inventory levels to also increase. Particularly in this segment, it grew by 24%, which again, like I pointed out, will show some concern to begin with. But as we go ahead and see the different categories and their respective performance benchmarks, particularly on the inventory levels and the metric of QTS, which I explained earlier, in the three charts here, you have the lower segment, the mid segment, and the higher segment. While the unsold inventory is trending up in the premium segment, which is 10 million and above, the QTS line, the line continues to trend down, which means it has become even better in the latest period. So while the inventory is increasing because of the strong sales velocity, there is no trouble as yet. But is it the same for all the subcategories within the premium category, within the 10 million plus category? No. There are certain segments which we'll see are witnessing some pressure. Now, to overall, for the 10 million segment, NCR is leading. Bengaluru has outpaced Mumbai, as you can see in the numbers. And together, NCR and Bengaluru account for almost half of the market in the 10 million plus category. We further segment these numbers to understand what's happening in the higher categories. 10 to 20 million, the next category, which is 1 to 2 CR, is now outpacing only as this particular category is outpacing the lowest category, which is 5 million and under 5 million. So 27% in the 10 to 20 million segment in terms of sales share versus just about 22% in the lowest category. If you look at the higher categories, the trend is very similar, whether it is a 10 to 20 million category, which saw 8% YOY rise, most markets, particularly led by Bangalore. Similarly, the others, which is a 20 to 50 million category, there also we saw very strong growth. In the 50 to 100 million category, in the 50 to 100 million category, we saw continued growth. 10 to 20 crore category, we saw 128% growth. Again, there as well, the inventory levels as well as the QTS numbers are very supportive. But when you look at the category of 200 to 500 million, which is projects or products from 20 crores to 50 crores, that is where some level of stress is building up, particularly because the inventory levels have exceeded the sales velocity. And it's showing up in the QTS numbers. 17 quarters is what we've recorded as of now, which means it will take more than 4 years for this inventory to exhaust. And therefore, you may see some signs of either supply moderation to tackle with or on pricing. Again, the top category, which is ultra luxury or products above 50 crores, there is no problem. It's doing exceptionally well. Only Mumbai and NCR have inventory in this segment, and sales in the NCR have exceeded those in Mumbai in H1, particularly led by the Gurugram market, which was performing very well. Now, this is the story of the luxury segment. We saw the big development, particularly on the interest rate front, and Shishir referred of the affordability index, which we brought out some time ago. We have continued to see affordability improving, and that has been one big reason why market has continued to maintain its trajectory, particularly now with this and when interest rates changing and affordability improving in this segment. The lower and mid segment are expected to come back. There are considerations from the supply side to pay attention to this lower segment as the performance at the top continues to get lonelier, based on the numbers we saw. So with this, the final findings that we have is sales and launches have plateaued in H1 2025. However, the market health is very stable at 5.8 quarters. Bengaluru is exceeding Mumbai when it comes to the more than 10 million category. And NCR has hijacked the luxury segment tag, and price rise gains momentum across markets. So with this, I'll close the presentation findings and invite Gulam Zia, our Executive Director, to take us through the question answer session.
Before question and answer session, I'll call upon Viral to give a few key insights from his side. Viral, over to you, please.
Thank you, Vivek, and thank you, Gulam, and welcome to our friends from the media. Vivek has given a very, very detailed understanding of the numbers. Let me just quickly touch base on some key emerging trends or bullet points of how we see the office market emerging. From a demand standpoint, I think we are at, in cricketing parlance, we are at half century and we are marching towards century. Maybe it happens in 18 months from now or maybe 20 months, 24 months from now. But we are certainly going from half a century not out to perhaps century, which would be a huge milestone from an office demand standpoint. The office demand continues to be robust, led by the various segments as we trend and as we track. I think the key area of concern, as Shishir and Vivek both mentioned, is the supply. And what we are seeing is office development and ownership is extremely specialized. I think there may not be more than perhaps 15 developers who have a presence in more than one market. So two and more markets, may not be 15 developers across the country. Highly capital intensive, leading to, perhaps one developer not making office space every year. So we're losing, developers who are making office space. Although, office space is doing extremely well, as you can see. But the first rent check from the land stage to when I first receive my first check is a 5-6 year cycle. And when residential real estate is doing well, it is becoming challenging for the office market. So the big trend that we see is domestic capital and certain developers may buy grade B assets in the office segment because still the vacancy across the country is 15%. But if you look at grade A assets, it's actually less than 5%. So you may see domestic developers buying these grade B assets. They may be strata sold multi-owners, or they may be old 20, 25, 30-year-old plus buildings. And they may repurpose that. The capital investment is not more than 10-15%. And the alpha that you will make on it is going to be substantial. Plus, it also means that you have speed to market. So that one big trend from a supply standpoint, hopefully, which will pick up pace over the next 6 to 12 months is large Indian developers buying grade B assets and bringing them to the market. It's already happening in their own portfolio, where most developers are, refurbishing their own assets. They will look outwards and do it. The second important piece that we see, I think the big threat, again, and I'm talking more about supply here, is while we are all concerned about what's happening to AI, etc., but I think the big real threat on the ground is the lack of supply and the pace at which it is coming to the market. That may lead to, a slight sort of headwind towards the overall office demand. I guess all other trends are captured, and I would be happy to answer to go into the specifics and numbers on what Vivek has mentioned. Thanks, Gulam. Over to you.
Thank you so much, Viral. Thanks a lot. And before we kickstart our question answer session, a few quick minutes on residential. Viral spoke about offices. Let me take a minute or two to talk about residential key findings. To me, the most important takeaway is that NCR takes the leadership position on luxury housing. It takes it away from Mumbai. Mumbai has been for years together the place where you would see high-end luxury residential transaction happening, lost to Delhi for the first time. And the margins are also pretty high. So that's a key takeaway for me. And on the other side, let me also set the backdrop. While a few of the reports that have started coming in are talking about an impending slowdown or a downslide of real estate market, perhaps the data we are capturing is slightly talking about a slightly different perspective. And the reason is, as Vivek tried to explain, while we are digging deeper into different segments of housing, we see a different picture emerging. It's very easy to just say that just because the inventory numbers have shot up by so and so, the market is on a downslide. It's again easy to say that a certain segment, mid segment, not working well, which is true, as we also realize that the segment which is 20 to 50 crore is actually going through a tough phase. But that said, overall market is not that bad, because the time taken to sell whatever inventory the developers have today is not more than 2 years. And that is actually for the developers, it's a good situation, because a typical time requirement for completing a project is on an average 4 years. So if a developer is selling all his inventory in 2 years and completing it in another 2 years, then it's a good position to be in. So net, we are of the view, our analysis says that the market is not in that bad a phase as a few people want you to believe. So with that, I open up this platform for question answers, and as our practice is, we would love the colleagues who are joining from various different cities to also chip in, either raising their hands, and we can connect them to our panel of speakers. And Shishir and Vivek, if you can come. So we have Viral continuing to be with us, and Shishir and Vivek are joining to answer your queries. So while I have a lot of questions already coming in on my chat box, I would also, because those who are physically here should take the lead. So those who are here in Mumbai, and let me also tell you, I don't know if my friends, journalists from the other offices can see our new office here, the new meeting area that we have created. I think it's good enough for you also to visit next time from wherever you are, Bangalore and Delhi, to come to Mumbai and see the infrastructure we have created specially for you all. So here we are. If I can ask anybody any question here in Mumbai, gathering here. Yes, please.
Yeah, with regard to the...
Slightly louder, please. I think it can catch, but still if you can be.
Yeah, with regard to the supply of office stock, as you said, that it is a few specialized players who are there in it. So what are the challenges? I mean, is it that real estate players, they find it easier to make houses and sell? And the fact that offices take a long time to, establish? And with regard, I mean, do you think that this problem can be solved if we have more institutional players like, say, Blackstone, Brookfield? I mean, how is this challenge going to be resolved?
So your question is multifaceted. To start with your basic, the question actually emerges from what is lucrative for a developer to build. Simple, because it's commerce. They're not here to do social service. So if you look at that perspective, you can also imagine at least last 3-4 years, we have seen residential really doing very well, and especially the upper end. The reason why everybody is focusing on luxury is because it's selling very fast and the margins are higher. Why people are not doing affordable housing is because it's taking a long time, and you sell 100 apartments and you perhaps make the profit which you would make by selling a 100 crore apartment in NCR. So It's written on the wall. Why developers are focusing on a specific segment. Now, that comes to even offices. As Viral just explained, the first money trickles in at least 4 to 5 years after you have embarked upon developing an office building. Whereas in residential, first of all, the developers actually collect from buyers advances on which they fund their development. So residential has always been financially much better proposition to get into if you're a developer. So it's very evident. Now, the second part of your question is with players like Blackstones, etc. Obviously, most of the work that is happening in office buildings, they are, if I'm not mistaken, at least about 25 to 30% of the inventory by now is owned by these institutions. Viral will correct me if I'm wrong. Out of about 1,000 million, at least 250 to 300 would be with these players. So they are definitely playing a big role. But then again, it's simple. Like in Worli, if you have an option to sell a residential apartment at 150 or 2 lakh rupees a square feet, something selling at even more than that is also in front of you. Then an office building, which will not fetch you more than 400 to 500 rupees rent, which means about 75,000 to 80,000 max out, not more than a lakh. It's very simple. The math is in front of you. So there's a reason why not many office buildings are coming up. That's exactly what Viral. Viral, you want to add up to that, please?
Yeah, I mean, I just want to great question, and somewhere you had your answer in the question, but on the second question with respect to institutions playing, they usually buying ready assets. Although some of them have started to take development risk also now. The big difference really is because it is capital intensive, and that's where institutions also come in. And some large developers, have been successfully doing it. There is a different motivation to make an office building. One, of course, is diversification from a developer standpoint. I think in India, you don't have to worry about demand largely. You are going to be able to lease out the space if you have a good asset. I think it's also tax efficient to hold the asset, and now you have REIT as a platform where you can, control the asset, manage the asset. At the same time, it becomes tax efficient. So, some of the large developers, as you can see in the country, whether it's DLF in North and some of the large developers down South, Prestige, Embassy, RMZ, Salarpuria, or Hiranandani, Raheja, Panchsheel in the West, you will see the same trend that they are diversified, and largely they are all going towards a REIT, and they're also in partners with some of the large institutions that you mentioned. And one last point, and not to drag this any longer, but the office market had like everything else during COVID 21 and 22 went down dramatically, and that's where the development cycle sort of halted in terms of conceptualization, and the effect of it is visible now. So in a couple of years, perhaps it should change, but at this point in time, next couple of years, serious shortfall of office supply.
I can just add follow up to that, the annuity income which they will get, once the office is done and established and they have the renters and all that. What kind of returns are they getting? I mean, would that be a kind of is it attractive enough for them to set up office as compared to a residence?
So, do you want to take it? Yeah.
I'll add my thoughts and then Viral can chip in. See, what you're asking is returns from the perspective of the developer, asset owner. If you look at the profile of returns of these, assets which are particularly in the public space, the REITs, and then obviously there are others in the private space. The public space REITs are at a very, tight or position in terms of their return profile, which means they're offering yields of 6.5% to 7.25%, which means it is very attractive for these developers if they can go through the entire cycle of construction and building a quality asset and ensuring that it reaches the public market. So, like Viral said, this is the complete cycle which one has to prepare for. If you rode it well, it is going to be a very attractive play from a returns perspective. The numbers vary, project to project. There are set of expectation depending on when do you enter at ready stage or land stage.
I was just saying the point. Till now, it was a very easy decision. If you go back to history from 2006-7, before the GFC took place, the commercial business went down for some time. Residential boomed up, and residential was booming right up to 2010, 2011. Then the residential market started coming down, and commercial hasn't looked back since then. This is one of the first times in 15, 20 years that all sectors of real estate are booming at the same time. So you have a phenomenal time when residential is at this near historic high, meeting 2010-11 numbers nearly there. Commercial is having blockbuster year after blockbuster year, most probably the third record year. You're crossing, I don't want to say those numbers, but perhaps could be 80, 90 million square feet. These numbers are not heard of in many cities, in many countries. And then you have a strong industrial warehousing and all parts of real estate. So the developer today has a choice to make. Earlier never had a choice. It was an obvious choice. Residential is going down, you build commercial. Commercial is going down, you build residential. Today you have a choice. You have a piece of land, as Zia said, in Worli or an outer ring road, and you have a choice. What do I do with this land? Do I do commercial or residential? The maths and the cash flow then make him decide, what is it? And they are very markedly different in both the asset classes. So it's a choice that he has to make, which is their own, depending on what the organization wants to do. There's a play that he has. So it's an interesting call that he has to make. Sorry, go ahead.
Okay. Can I take one from outstation and then come back to Mumbai, please? So first of all, there is someone who wants to connect and talk to us. Nisha Pandya. Can we connect Nisha to the system, please? Nisha, you can unmute yourself and start talking, please, Nisha.
Okay, good afternoon, everyone. This is Nisha Pandya from Real State of Real Estate. जो सिटी वाइज सेल्स एंड लॉन्चेस जो हैं उसमें मुझे खास मुंबई ये दिख रहा है क्योंकि वो टॉप पे भले ही है सेल्स में, लेकिन अगर वाई चेंजेस देखें पिछले साल के मुकाबले कोई बदलाव नहीं है, बल्कि लॉन्चेस में 3% की कमी देखी गई है. तो क्या आने वाले टाइम में उसका क्या इम्पैक्ट होगा?
Nisha, if I can remind you of the first slide which Vivek did on residential. Overall, it's a very flat market. A 2% or 3% up or down, we are not yet willing to take it up as a sign unless we see it continuing for a few quarters or a half yearly or two. So just a 2% or 3% here and there is not much of a difference. And then focusing, Nisha, on launches that you're talking about, again, similar trend. A little less number of launches is once again not an indicator of changing times per se. So I would once again ask everybody to be a little patient, look at a few more data sets before writing any kind of a verdict. That's our point, Nisha. Hope it is making sense.
Yeah, sure. Thank you.
Thanks a lot. So here, if I come back to Mumbai, yes, please.
Yeah, couple of questions. One on Resi. There's been a couple of years of euphoria in the above 20 CR segment. Do you think the current slowdown, if I may call it, is it just a broader market trend, or is it because of the recent flux in the capital markets? And number two is about offices. You mentioned the fact that more institutional players are needed in the office space to kind of have that influx of capital and to kind of expand the offering as well. But there have been players coming in, Japanese investors, American, Canadian investors. How much more, what is the quantum more that is needed to kind of supercharge the supply?
So two parts to your question. First part is about residential, and you specifically spoke about 20 crore plus kind of category, and you are trying to understand, is it due to any meltdown in stock exchange equity or wealth creation? I would say, again, it's not good enough of a data point to talk about, because while that is happening, you still have somebody like a DLF selling 100 crore apartments like it was never
market, right? That is a kind of sui generis market in
some 100 plus apartments sold. So if you look at the kind of action happening in that segment, is once again defying all logics, etc. The focus again, if you go back to our data sets, the 20 to 50 crore is the only segment where we are feeling the heat. And again, the reason is right there, that the inventory for last 2.5, 3 years is so much that the velocity of sales compared to the new inventory that has come in that specific segment is not matching. And that's the reason it is going to take you about 4 to 5 years to sell all that inventory. That segment apart, if you leave that apart, every other segment you have, whatever inventory you have will be sold off within 2 years. So nothing to worry about except for that segment. And that segment is so unique. If I have to ask somebody, why are you not buying an apartment in 20 to 50 crore segment, but buying 50 plus crore segment? Very awkward, because that question itself, we cannot attribute a reason to it. The way things are going, you cannot say that because of any so and so reason, only that segment is impacted. So impact of wealth creation, wars, equity, whatever is happening in stock markets and this and that shall be across all, 10 to 20, 20 to 50, 52 plus 100 crore, whatever it should be everywhere. But only that segment, as I said, it's purely because of a lot of inventory coming in. The second part of your question was, while earlier continuing from where she left, we spoke about, maybe we only spoke about Blackstone and Brookfield. You're trying to say that there are so many others also joining the bandwagon, Japanese, Canadian, a lot of them are actually always there. The Japanese funds that we started seeing in last 2 years is perhaps the only new entry. Otherwise, most of the others, the Canadians, all of them are always there. Even the Middle Eastern ideas, etc., are always there. So this addition, here one point important which all of us are making is that office sector is not getting enough of inventory. As Shishir started, as Viral said, Vivek spoke about, that while we are breaking new records in transaction, the big worry is that not enough of new inventory is coming. And, these funds will come in only to support some developer. Once a developer embarks upon their journey to make an office space, I think fund availability is a plenty. It's not that we are falling short of capital and hence not doing offices. I would not agree to that concept. The reasons are various, as Viral was trying to explain, as Shishir said, a lot of reasons why people are not yet touching office market. Capital is not one of them. Shishir, would you want to say something more than that?
No, I think the fact that supply is still there. The point is the supply may not be meeting the scorching demand that's there. Because the demand is today, we look at it and Viral just chip in whenever you want to. In 23, we touched 60 million square feet. In 24, we touched 70 million square feet of annual absorption, gross absorption of space. This year, your planning perhaps could be 80, 85, I don't know what, depending on what the H2 numbers are in terms of its pre-commitments, but H1 pre-commitments were immense. So the point is whether supply can match that scorching demand that's happening in the office segment is the issue. If you look at a normal supply, you're still managing it. You look at, so where is the worry today? If we look at many times, because we get paucity of time in these conferences, you're looking at demand, the vacancy levels have gone down to 16, 17%. But we've actually broken that also down to micro markets. And again, Viral will come in here after when I finish speaking. In most of the main micro markets, which are client-facing grade A markets, the vacancy is sub 5%. Whether you look at BKC, you look at Lower Parel in Mumbai, you look at in Gurgaon, or you look at High Tech City in Hyderabad, or the ORR or Whitefield in Bangalore, it is actually sub 5%. Means you're really talking about 100% occupancy in those cities. And that's the worrying thing, whether supply can take pace to meet the demand. Viral?
Yeah, also the depth of the capital markets, since you mentioned capital markets in your question, there are 35 listed REITs in Singapore. If my numbers, I'm not an expert on the Singapore market, but and the size of the listed REITs in India, I think may not be more than 10, 12 billion US dollars market cap wise. Whereas the US is 2 or 3 trillion US dollars. So you're talking about, and this is the best performing office market in the world today. Whereas Shishir quoted the numbers, most markets have something called as negative absorption. And negative absorption, which means here annually gross absorption is likely to touch 80 million. There, people are giving up space. So if the total stock was 100 million in a market, it became 102 million because 2 million square feet of space was given up. So, from that perspective, there's more capital which will come into the market, and it's a matter of cycle, etc. There's various things. REITs are only about 4-5 years in the country. There are only 3 office listed REITs. 2 more are likely to come in the next 6 to 12 months. So, but the demand maturity, I think it's phenomenal and it's still growing. So you have that disparity, and that is the driver is the success of residential market. And as Shishir mentioned, where you have choices, where do I deploy capital? And that's what is happening. And office is highly specialized. Not everyone can do it, given the scale, the size, the quantum of investments. Thank you.
Thanks, Viral. Can alternate? Sorry, you have a question for the.
Just to follow.
Yeah.
It's about the REITs actually, because you mentioned that there are REITs already there in the country and which have $10-12 billion market cap and all that. Do you think more players are not coming in, or more players are not floating REITs because the yields are maybe not not up to global benchmarks, or even like benchmarking against the 10-year sovereign bond?
Should we take that question? No, that's a subject which I think. Sorry, you want to take that, Viral?
Yeah,
we actually defocusing a little. It's a capital market report which we just released a few days back. But let Viral give you a quick answer.
The office market in India is a 30-40-year-old story, maturity, in which you have had GFC, you have had COVID between all of this, right? And REITs are only just about 4-5 years old. So by the time, and you have 10-12 large developers across the country who have the combined value of asset which is required for a sizable REIT. Of course, retail participation, equity markets have done well. Again, the investor had a choice where to put the money. But to answer your question, I think REITs have done reasonably well, and hence 2 more are hitting the market. Many more will follow, but we have to have that depth which is still evolving and happening.
Okay, I'll request Piali to take over the question answers. I have to rush for something else. So meanwhile, I'll read this question, and please, I'll come back to you. As I said, we are alternating from digital to physical questions. One question, Piali, please come. One question I'll read before I move on is from Jadav Kakoti. Will Tier 1 and Tier 2 cities be emerging as new luxury destinations in near future? Shishir, I'll leave you to answer this question. Tier 1 and Tier 2 cities, luxury housing coming up. If you can take that. And meanwhile, Piali will take care of question answer. I'll see you all later. Thank you so much. See you later.
I think the report really focuses on the top 8 markets at this point of time, and that's where we've analyzed the numbers for this one. But I think there is a trend towards the next levels of market, and I think there is a growing interest in the Tier 1 and Tier 2s also, both again for some of the commercial office segments as well as for in the residential parts of it. But at the moment, I don't have data to say really whether in Tier 1 luxury housing and what really accounts for luxury housing in that part. What is the price range that will then say that is luxury housing? Perhaps we'll, Vivek, if you want to just...
So to add to Shishir's viewpoint, the positivity that we've been seeing in the housing market is not a limited phenomena to India or to the top 6-8 cities. It's globally been the case for the last 5 years. It's continuing to be so. But when it comes to luxury and the definitions of luxury that we have covered in the report, particularly in the 20 CR, 50 CR segment, that is really even within these 8 cities is concentrated in Mumbai, Delhi, Bangalore, Hyderabad to some extent. right? And that is, where, you have both, activity happening, both from the demand as well as supply side. Other markets here and there, some independent houses, some, but largely the ultra luxury segment is the phenomena of these 2 to 4 top markets. Otherwise, housing markets across have benefited with this, upside.
So I'm going to ask a question out of the chat box now. Maulik Bhavsar has asked what are the key roadblocks to real estate growth? Now, seems to be a little bit of a misalignment. Nonetheless, he's asking what are the roadblocks to the real estate growth, and how do other cities compare to, in an overall factor, to Ahmedabad? So, cities overall growth, and how does it compare to Ahmedabad?
So I can begin with this. So when it comes to roadblocks, see what have we seen in these? We know in terms of the macro scale of the real estate market, housing is the maximum in terms of, most in terms of the defining factor in terms of developer fortunes and industry fortunes, right? Now within there, the growth rates have continued to come down, right, over the last 4 years, even while we are in this upcycle. Why? Because it's becoming lonelier at the top. The participation of the low and mid segments has to come back, and has to come back in a very strong manner if we were to really, build depth into the market. There are a host of reasons which can ensure that it happens, but then that is where, attention has to come back. Luxury is doing well. We still feel, it will continue to do, but then, growth rates have already started to taper off. On the office side, we already saw what are the reasons, which may serve as a roadblock, particularly in the scale of supply, which is very much curtailed.
So we can.
The only thing I can add in this, is that I think the scale of infrastructure in many cities is pushing development. And I think what we are seeing today in Mumbai, the connectivity and the reports that we have just come out with today, far-flung areas right up to from in the next 4-5 years, from Andheri, Mud, etc., right up to Nariman Point. Once was a 3.5 hour journey, could perhaps be made in 45 minutes to an hour. And all are happening now. The metros coming in, the roads coming in, the coastal road connectivity, and we're seeing that in cities like Bangalore, NCR. And so proximity is becoming better and better. And this is when proper grade A supply in many offices will come across in other areas, rather than being dependent on only one historical area. So I think many of the roadblocks that were there earlier of lack of infrastructure is being sorted out in most cities, but it needs to keep pace, and it needs to develop further. And I think that's also happened in residential places, like coming towards the new airport and the whole development of a new section of Navi Mumbai International Airport, where they're going to be developing the new CBD coming, hopefully at some stage when the Dharavi development happens. I don't know whenever that happens, are new structures that are going to happen. But this magnitude of infrastructure development, we've not seen in decades, that is now being seen. And I think these are really clearing many of the roadblocks that were there earlier. Sorry, you were saying something.
I just wanted to ask, in fact, I was talking to him earlier also. So are you seeing any kind of a incipient rise in sales of houses priced in the 50 lakh to 1 crore category? Initial trends, is it there?
So that is, and I'll let Vivek answer this, but if you...
In that case, do you see it as a long-term trend, sustainable trend, or is it just for a little?
So that is where the issue is on the sub 50 crore, sub 1 crore, sub 50 lakh, 1 crore segment. And that segment, and that is where, when I said initially in my introduction that when we went down and we dissected those numbers, it gets hidden in the headline numbers. But we've been seeing that over the last few years, that while residential sector started putting its weight and started going to decadal highs, this segment was really coming down and falling down. And that is where the PMI scheme, or when the cumulative 100 basis point cuts, out of which 85 basis points is being passed on, will help that consumer in that segment to start adding to the demand. But having said that, even supply needs to pick up in that segment. And that is when we are looking at perhaps more fiscal incentives that the government will give, or development will happen for that segment under 1 crore to come up. Yeah, Vivek?
So to add on, see, when it comes to big causes which are very capital intensive, long-term in nature, complex, like say infrastructure, the burden of carrying all of it is on the shoulders of the government. But when it comes to housing, the cause of housing has to be and is been clearly given to the private sector, right? Most of the inventory that keeps coming in, okay, 90% plus across markets is coming from the private sector. So it's the private sector which has to channelize the products in this segment. As that happens, we will see revival in this segment. Okay, the less than 50 lakh category or the 50 lakh to 1 crore category. Yes, what has happened over the last 5 years is earlier, the lowest categories start to fade the first, and then started to spread in the other categories. As
the reason I'm asking is, since you said that affordability has been the this hit record levels has been best in so many years, so I'm assuming that
So that is where I think we are expecting it. That's where the increase will start coming in, and that's when we said that even this 50 basis point cut that happened in the last month, perhaps the greatest beneficiary will be people in that segment, which will get the demand back. And that is where I think, if you look at it in the larger platform at the base of the pyramid, that is where the major demand lies. And unless that starts firing, I think the whole residential sector will see a different boom altogether if we address that part of it. And I know number of our banks and financial institutions are all also focusing on that segment now.
Thanks. I'll take a question from the list here. This is a question which Viral has been discussing at length. So Viral, if you can please come back for this one. This is from Kanchan Gogate, and he's saying that though we are back to work from office, is remote working and AI impacting office space market? I think Viral, we've discussed it at length. So your thoughts on this, please?
Yeah, so I'll give you a stat for everyone, and this is purely given that about 60-70% of all office demand is sort of the work that happens, the global work that happens out of India, right? So, which is a factor of IT exports. So in 2007, the IT exports in the country was about 40 billion US. In the gone by fiscal year, the IT exports, I think, is touched 275 billion US dollars. In 2007, $1 billion of IT exports was generating 700,000 square feet of office demand. Today, $1 billion generates 260,000 square feet of office demand, which means it factors in everything that you're asking about, which is hybrid, which is work from home, which is hot desking, which is optimization of office space. You had those boxy big sort of chairs and tables, which is now far more efficient, etc., open layout. So there is a scale down, and office market has become far more smarter. The same $1 billion generated 3 times more office demand in 2007 to now. Although office market has dramatically increased from 30 million to today close to 80 million 80 million square feet, and so as the IT exports. IT exports, even during COVID, even during GFC, only grew at a CAGR of about 10-11%. And that's the story of the office market. The second question was about AI. Very hard to predict what is likely to happen, but I think given the momentum that we are seeing, we're not seeing any big significant change. Generally, any form of disruption leads to some other kind of demand, and that's been the trend over the last 20-30 years. Whether it is any form of disruption, whether it is e-commerce, to retail, where both are surviving and doing well, or whether it is disruption of another form, which was COVID, leading to this heightened residential demand. We will see how that shapes up with respect to AI, but at this point in time, I think all we are hearing from occupiers is that AI is making work efficient, and the adoption of AI at enterprise corporate level versus individual. A lot of you may be using AI individually, but your firms may not be are yet to adapt to AI. So individual usage of AI is far more than it is at enterprise corporate levels as yet.
Thank you, Viral. I will have to. We are running out. Question. Sorry. Yes.
Sorry.
Please go ahead.
You were talking about residential real estate will pick up only if the bottom of the pyramid. What exactly does it take for builders to actually start taking that market seriously? Because we've been talking about declining sales in that segment for a very long time. At the same time, in the same presentation or a release, we would say that 6.3% India growth, GDP, new aspirations and all that. But below 50 lakh is 6 to 7 times the per capita income, and that has to grow, right? So what exactly will it take for an a builder to take that segment seriously?
I think great question. And I think this is where I was saying this sort of preamble on the initially said what will take for the residential market to pick up. But I would just want to say that the residential market is nearly on a 5-year, 10-year high. But because of those headline numbers, the ills that you mentioned get hidden. The fact that the under the 50 lakh segment is coming down. Yeah, Vivek.
Yeah, so reasons, particularly some of these are getting addressed in the background, which is the infrastructure development that he spoke about. See, what does a customer, you have to think from a home buyer's point of view. What does a customer who's buying a 30 lakh rupee apartment, 50 lakh rupee apartment, 60 lakh rupee apartment wants? He wants a house which allows him to go to work, has social infra, which is in the form of schools and so on. Whether it happens in the heart of the city, CBD, or it happens in the peripheries, but well connected. So the range of infrastructure development that has happened across cities. We are in Mumbai, we see the kind of scale of infrastructure development which is unprecedented. You go to say an NCR kind of a market, the RRTS, rapid regional metro rail transport network which has been developed. It's brought markets like say Delhi and Meerut from 2-hour, 2.5-hour travel time to 1 hour, right? And then similarly, there are many other infra projects which are trying to do that. With that, what will happen is the supplies of land will enhance, particularly from a value perspective for developers to embark upon. Okay. And because you can't expect prices to be lowered in the prime markets or in the markets where they have gone beyond say 10,000 rupees a square feet, 10,000 rupees a square feet. Supply of land has to be created, particularly infrastructure, mass scale infrastructure projects do a very good job in doing so. And then obviously the private sector interest has to come back from a money making premise perspective, and that is not an absolute answer. It's a relative answer based on the options or choices they have.
So, and the ease and accessibility of funds. And I think that's when is really coming in. With interest rates going down, with banks like, HDFC and the others really putting in a huge amount of focus on affordable housing today. And I think that part of it is really going to help as long as the funds get accessible and the cost of funds is easier. I think that sector will take off, and it has to take off. It is national interest.
RBI has reduced the threshold for priority sector lending, which also includes home loans. Now, a second point I want you to kind of address is what I don't understand is whenever there is a suburb that's being connected. Now we also have Bayandar is connecting here. Whenever the suburb connecting, it starts with 50 lakhs. I am from Chennai, and I as much as I've lived in Chennai all my life, and all I've seen every time there's a suburb being connected, infrastructure development happening, it exits the 50 lakh automatically. So something is happening there that is making completely difficult for real estate builders to kind of sit within the affordable home segments. That is what I want you to address.
You're right. In fact, that's one of the things that we are addressing, and we are thinking that unless we address this issue, and whatever, regardless of what the center says, unless this issue is addressed, availability as well as developers come into this project, into this segment size, it's going to be difficult for it to move. It has to get affordable, and it has to get accessible to funds, as well as it has to make sense for developers to come into this market. And only then this will pick up, right, Vivek?
Yeah, correct. And then to add to on the point you made, Sushil, it is not just the infrastructure, but are we ahead of times when it comes to comparison to the development, real estate development? As in, you look at, say, the Navi Mumbai International Airport, right? It's going to commence operations, commercial operations this year. But then we've been selling property for the last 20 years, right? So even if it comes, it is come much later. And airports do not have a direct role in terms of enhancing land supply. It only enhances the activity level in that commercial activity in that region. But it's really those metro networks, suburban train networks, the roads and bridges. Now, if these come well ahead of time, then certainly this price pressure that you highlighted in many of these markets, which are severely supply starved, will not come up. But if it is coming with a 10-year delay, 20-year delay, it will. Thanks.
Well, thank you so much. I think we're at close to 2 o'clock.
Yeah, thank you so much for being here. And I know we've overshot the time, but I'm glad we had this very, very interesting question answer session. And I hope you find the report interesting. The reports can be downloaded and have been sent. And we're happy to take any other questions that you have post this. And thank you once again for attending the session. Thank you.
Thank you.
Thanks, Viral. Thank you, everyone.